Are you ready to start building your wealth and securing your future? If you're in your 20s or 30s, it's not too early to start investing for your retirement. Trust me, your future self will thank you for it. And if you're worried that you don't have a lot of options, don't fret, because investing early is one of the best ways to ensure a comfortable retirement. In this video, we'll dive into some of the most crucial investment decisions you can make while you're young. And let me tell you, there's more to it than just stashing your money in a savings account. By investing early, you can set yourself up for a future filled with financial freedom and stability. So, sit back, relax, and let's get started on this journey to secure your financial future. We'll cover various investment options that can help you grow your wealth, and who knows, maybe you'll discover a new investment strategy that's perfect for you. Don't forget to hit that subscribe button and turn on the notification bell so you never miss out on our latest videos. Let's make your financial dreams a reality together. 1. Index funds. Stocks are one of the best investments you can make before turning 40. While they may have very high risk, the returns are among the highest. Investing can seem daunting, but it's never too early to start building your wealth. And one of the best ways to do that is through index funds. Not only do they offer high returns, but they also provide diversification and have low fees. But don't just take our word for it. Let's look at the numbers. The average return rate for stocks is around 10%, based on the S&P 500 index as a benchmark. And while bonds may have a lower return rate, they offer more security for your investment. So, it's recommended to have about 10 to 20% of weighted bonds in your portfolio. And with the recent introduction of crypto index funds, the potential returns are even higher, ranging from 10 to 15%. However, with higher returns come higher risks, so it's important to make calculated and smart investments. Remember, fees can quickly eat away at your returns, so it's important to choose index funds with low fees. And don't forget to consider the tax implications as well. So, whether you're in your 20s or 30s, it's never too early to start investing and building your wealth. And index funds may just be the perfect option for you. 2. Real estate. Real estate is a fantastic investment option that can yield incredible returns, and there are multiple reasons why. For one, there is always a high demand for housing, which means that real estate assets typically appreciate in value over time. If you're looking to get started with real estate investing, the first step is to purchase your own home. Not only will owning a residential property help you save on expenses like rent, but it will also serve as an excellent foundation for future investments. Once you own your own home, you can start looking into building other commercial properties such as multi-unit homes, townhouses, offices, and other properties. However, if you're not able to invest directly into the real estate market, there are still other options available to you. There are now several crowdfunding platforms where you can invest as little as $500. The money you invest would then be collectively invested into real estate properties alongside other investors' contributions, and these investments are known as REITs, real estate investment trusts. So whether you're a seasoned investor or just starting out, real estate can be an excellent addition to your investment portfolio. With its potential for high returns and multiple investment options, it's definitely worth considering. Don't wait any longer to explore the world of real estate investing. 3. Education. Are you in your 20s or early 30s? Then, you are in luck. Studies show that this is the best time to invest in education. Whether you want to pursue an extra degree or improve your financial literacy, this is the time to do it. But, be careful, not all learning is an asset. While it's great to pursue your passions, some hobbies may not bring you a return on investment. So, focus on careers that you're interested in and have a good chance of success. Investing in education is important because it sets you up for a successful career. Plus, learning doesn't have to be expensive. You can find many free courses online, attend seminars, or even join mentorship programs. So, don't let a lack of funds stop you from investing in yourself. Remember, education is an investment in yourself, and the earlier you start, the more you can benefit from it. So, take advantage of this time and invest in yourself to achieve your goals and set yourself up for a successful future. 4. Startup business. Investing in a startup business can be a great way to grow your wealth, especially in your 20s. The potential for explosive returns is incredibly high, and with an unlimited ROI, the sky is truly the limit. While starting your own business can be a daunting task, you can still invest in other people's businesses in exchange for equity in their company. Angel investing is a great option if you know the founder personally, and your investment can be in the form of a convertible note. Alternatively, crowdfunding platforms can also offer opportunities to invest in high-potential startups. However, before investing in a company, it's important to do your due diligence and research the founder and their business. Choose companies with a strong storyline and founders who have relevant education, experience, or training in the business industry. Finally, working with a venture capital fund can also be a great way to invest in startups, but keep in mind that these funds often require a significant minimum investment and have strict qualifications. With the right investment strategy, a startup business can be a great way to grow your wealth and achieve financial success. 5. Treasury bills. Investing in treasury bills is a wise choice for investors of all ages, especially for those who are young and looking to build their wealth over time. Treasury bills are short-term, government-guaranteed debt instruments with 3 tenors: 90 days, 182 days, and 364 days. These bills are issued to finance government expenditure and control the money supply. Investing in treasury bills is an excellent way to achieve the finance concept of asset and liability matching, where you purchase an asset to finance the payment of a future liability. For example, if you have bills to pay, such as tuition or rent, you can invest the money you have at hand into treasury bills and cash out when the bills are due. Treasury bills are entirely risk-free, and your returns are guaranteed, making them a reliable investment option. The returns on treasury bills are relatively decent, making them an attractive option for investors looking for a low-risk investment with guaranteed returns. So, if you're looking for a safe and reliable investment option, consider investing in treasury bills. 6. Growth stocks and dividend stocks. Growth stocks are stocks of companies that are expected to grow at a significantly higher rate than the industry average. These companies tend to generate more sustainable positive cash flows and revenues than their peers. Investing in growth stocks can result in higher capital gains but also carries higher risk. Dividend stocks, on the other hand, are stocks of financially stable and mature companies, which means the share prices are less volatile than growth stocks. Dividend stocks should be included in your portfolio at a young age because they provide opportunities to earn a consistent income over a long period of time, provided the companies keep performing well. It's important to diversify your stock portfolio between growth and dividend stocks to balance risk and reward. Investing in a combination of both types of stocks can provide you with a solid foundation for long-term financial growth. However, it's crucial to do your research and carefully evaluate each company before investing. 7. Exchange-traded funds. Exchange-traded funds, or ETFs, are a great investment option for those looking to diversify their portfolio. Similar to index funds, ETFs are baskets of securities that hold multiple assets such as stocks, bonds, and commodities like gold. ETFs are traded like stocks, which means they can be bought and sold on an exchange, making them a convenient and flexible investment option. ETFs offer investors the opportunity to invest in broad market indices such as the S&P 500, or in specific sectors such as technology or health. ETFs can even invest in subsectors, such as social media or robotics, providing investors with a broad range of investment options. Some examples of ETFs include the Schwab US Large Cap ETF, the Global X Robotics and Artificial Intelligence ETF, and the iShares Global Clean Energy ETF. Overall, ETFs are a valuable tool for investing in a diversified portfolio. 8. Commodities. In economics, a commodity is an economic good, usually a resource, that has full or substantial fungibility, that is, the market treats instances of the good as equivalent or nearly so with no regard to who produced them. There are several ways to invest in commodities. One way is to purchase varying amounts of physical raw commodities, such as precious metal bullion. Investors can also invest through the use of futures contracts or exchange-traded products, ETPs, that directly track a specific commodity index. These investments can be highly volatile and complex and are generally recommended for sophisticated investors only. Another way to gain exposure to commodities is through mutual funds that invest in commodity-related businesses. For example, an oil and gas fund would own stocks issued by companies involved in energy exploration, refining, storage, and distribution. The advantage of commodity investing is diversification in the portfolio, potential returns, and a potential hedge against inflation. In addition, commodities have shown robust performance during inflation periods, making them a good asset to consider owning. 9. Annuities. Annuities are a type of financial product that offer a contract between an individual and an insurance company. The company promises to make periodic payments to the individual either immediately or at some point in the future. An annuity can be purchased with a single payment or a series of payments, known as premiums. Annuities can be used for retirement savings or to create a stream of retirement income. If an annuity is purchased as a savings vehicle and the payments are delayed to the future, it is called a deferred annuity. If the annuity is used to create a source of retirement income and the payments start immediately, it is called an immediate annuity. The two most common types of annuities are fixed and variable. A fixed annuity provides a guaranteed rate of return, while a variable annuity offers the potential for higher returns but with more risk. There is also a hybrid type called an indexed annuity, which is also referred to as an equity indexed annuity or a fixed index annuity. Annuities are often marketed as tax-deferred savings products, but they come with various fees and expenses, such as surrender charges, mortality and expense risk charges, and administrative fees. Annuities can also have high commissions, sometimes reaching 7% or more. It is important for investors to fully understand the fees and potential risks associated with annuities before investing in them. 10. Cryptocurrencies and initial coin offerings. Are you ready to enter the exciting world of cryptocurrencies and initial coin offerings? These markets have recently captured the attention of investors from all backgrounds, with billions of dollars raised in ICO financings and over 1,000 different cryptocurrencies available. It's no wonder why so many people are tempted by the high potential returns, ranging from 12% to an incredible 200%. But with complexity comes confusion, and it can be difficult for individual investors to navigate these markets and determine their risk levels. However, despite the challenges, the rewards can be astronomical. Just look at the OTA, which had a return on investment of a staggering 13,000 times. That means if you had invested just $1 when it was offered, you would have made $13,000. So whether you're an experienced investor or just starting out, it's important to educate yourself on these rapidly changing markets and consider the potential rewards and risks before diving in. Who knows, you could be the next investor to strike it big with cryptocurrencies and ICOs. By investing early, you can set yourself up for a comfortable retirement and financial freedom. Remember, it's never too early to start building your wealth, and with the right investment strategy, you can achieve your financial goals. So, don't wait any longer, start investing today and make your financial dreams a reality. And don't forget to hit that subscribe button and turn on the notification bell so you never miss out on our latest videos. Let's make your financial dreams a reality together. See you on the next one.